Trump administration has tried to cultivate a reputation for preferring Main Street over Wall Street. Unfortunately, this image is belied by the administration's renewed push for a monetary policy of artificially low interest rates and monetary inflation. By embracing these policies, Trump has put himself squarely in the camp of coming down in favor of Wall Street over Main Street. This is because a policy of monetary inflation and low interest rates favors wealthy owners of assets while imposing higher prices and fewer income gains on people of more modest means. The Trump policies of inflation and low interest rates fuels levels of inequality far greater than would exist under relatively free market conditions. This is because the low interest rate policy increases disposable income far more rapidly for people at higher income levels than it does for people at lower income levels. Contrary to the long-standing leftist myth that poor people benefit most from cheap money, it's actually the wealthy who most reap the rewards of low interest rates and inflationary policy. The assumption behind the myth is that poor people go into debt more than wealthy people, and therefore it's the poor who benefit when they pay back debts in devalued currency. That version of things is false on every level, though. First of all, the wealthy take out loans far more than the poor. When it comes to home mortgages, for example, the top 10% in terms of wealth has more debt than the bottom 50%. So which group will get an outsized benefit from paying back debts and cheaper money? It's the top 10%, not the bottom 50. Second, easy money fuels asset price inflation, and that's only helpful if one owns a lot of assets. It's not so great if, like most lower income people, one doesn't own a lot of assets. As a growing number of empirical studies have shown, the net benefits of low interest rate policy for lower income groups, when there is any benefit at all, is very slight, while the benefits for higher income groups are far greater. We're forced to conclude that Trump's current drive for lower interest rates and more easy money is doing little or nothing to help the working class people Trump claims to represent. In fact, his policies are probably hurting them, and his policies are definitely helping to enrich the highest income levels the most. Now, strictly speaking, we don't need new empirical studies to know that inflationary monetary policy, such as low interest rate policy, favors the regime and its wealthy friends first. We can deduce this from the work of Richard Cantillon, who showed that new money enters the economy unevenly and is most beneficial to those who get access to the new money first, much like how counterfeiting works. Those who get it first can spend it before prices adjust upward to reflect the devaluation. Now, these observations from an 18th century economist, Cantillon, have been proven right historically again and again. But we also have more recent empirical studies to add some details to how Cantillon's ideas apply both in the United States and abroad in modern times. For example, a November 2023 study from Raghuram Rajan noted that while central bankers, national governments, and other sophisticated financial sector players clearly benefited from COVID-era easy money policies, the unsophisticated, quote, and the relatively poor get drawn in at the tail end of an asset price boom, creating problematic distributional consequences that the central bank has some responsibility for, unquote. Put another way, loose monetary policy created asset price inflation, but ordinary people mostly just felt the effects of rising prices later in the process. So unlike the wealthy, they didn't benefit much from the rising asset prices in their portfolios, assuming they had portfolios at all. Another recent empirical study on the effects of low interest rates and easy money is Karen Petru's 2021 book, Engine of Inequality, and that's a reference to the Federal Reserve. Looking at low interest rate policy as implemented in the United States, Petru notes the effect has been extremely beneficial for the wealthy. Because so much money has been injected into the financial sector, stock prices have skyrocketed, and the prices of other assets, especially real estate, have soared. Petru shows that if we look at the data, though, we find that this economic boon hasn't done much for those who don't already have robust stock market portfolios and real estate assets. The lower half of the U.S., in terms of wealth and income, they're not doing as well. In fact, from 2001 to 2016, the median wealth of Americans in the bottom 80% of income earners fell. Trump now supports the same monetary policy behind that trend. Now, also of interest is an October 2023 article in the Journal of Finance by Asger Lau Anderson and several other authors. The study is a very large examination of household-level data covering the entire population of Denmark over the period from 1987 to 2014. The authors conclude that while low interest rate policy clearly helps boost the wealth of wealthier segments of the population, the average gains for people at the lower end are far smaller and in some cases negligible or quote unquote precisely zero, as the authors put it. Specifically, the authors write that low interest rate policy, quote, generally increases the value of household portfolios of stocks, but that these gains are highly concentrated at the top of the income distribution. The estimated gain created by 1% decrease in the policy rate, that is, when we're talking about central banks cutting interest rates, we're talking about cutting the policy rate. So when you cut that policy rate by a 1 percentage point decrease, the gain is 15% of disposable income in the top income group, but the gain is entirely negligible below the median income level, unquote. The authors also conclude, quote, the results imply that a 1% point decrease in the policy rate increases disposable income by around 1% in the middle of the income distribution, which compares to more than 4% of the top income group and almost precisely zero for the lowest incomes. Although many advocates of easy money policy say it fuels greater employment, the authors are skeptical of its benefits for the lowest income groups, stating, quote, the results also highlight that the most disadvantaged groups who have very low employment rates through the business cycle do not appear to reap any gains through the labor channel. That is, there's just not those gains of employment, they're just not benefiting people at the lowest end. When people, and even when lower income groups benefit somewhat, the wealthy reap far larger benefits. The authors go on, quote, there are some clear winners and losers. When rates fall, disposable income rises for high and low earners both, but it's households within the top 1% of income who benefit most. We found a 1 percentage point drop in interest rates boosted the incomes of these top earners by 5% over 2 years, while the lowest earners saw only a 0.5% rise. Those in the middle saw an increase of 1.5% in their income. So we're seeing many times better benefit to the higher income levels than the lower. And this isn't natural inequality, remember. This isn't market-produced inequality. This isn't a result of the natural world. This comes from government policy that is redistributing wealth along these lines that are benefiting the rich over the lower income. So taking all of this into account, it's easy to see why higher net worth individuals, and of course the financial sector, are always clamoring for lower interest rates. Lower interest rates are a boon for those with sizable portfolios. Those who own few assets, on the other hand, are lucky to eke out even a small gain from the policy. So when we see Trump pushing the Federal Reserve to further lower interest rates, we can see that he's coming down squarely on the side of Wall Street and the wealthiest households, who so clearly benefit from ongoing monetary inflation and low interest rates.